So welcome everyone to this Truflation's Twitter space. My name is Aurélien and I'll be your moderator for today. So in this session, we'll discuss the upcoming Fed announcement and offer our prediction. We'll start off with Oliver Rust as usual. We'll discuss retail sales, unemployment data, CPI, GDP, household debt, and then give a suggestion on the interest rate increase uh, for the announcement tomorrow. Then both Stefan Rust and Ivan Yarik will provide more comments before we finally open the airways for Q&A. So we expect each section to take about 10 to 15 minutes for a total of 45 minutes. Just please remember when we open for a Q&A to be courteous with your questions. We want this space to be respectful and focused on the data and the interpretation of that data. So if you have questions, make sure to let me know that you want to be a speaker later on. If you have questions but don't want to be a speaker, you can just ask the question as tweets. You can tweet those questions at Truflation, and you can add the hashtag Twitter space so that I know that this is for this specific session. I'll monitor the feed and I'll ask those questions as I go, whenever relevant, or later on during the Q&A. So thank you everyone for being here, and Oliver, whenever you're ready.
Thanks a lot, Aurélien. I hope everyone's got their coffees for this early morning start. So first of all, thanks all for joining. What I wanted to do after this tumultuous week last week, and actually this weekend with the latest update in the banking world with Credit Suisse, is just to reiterate some of the Fed's objectives and what the Fed has been doing. So I'm sure all of you know the Fed has got three major pillars that it's focused on. One of them, of course, is unemployment. The second one is around inflation. And then the third one, of course, is around financial stability. And that third pillar is increasingly becoming an area of topic, given the banking activities and the cost of loans on those interest rates that people are having. So I think if you look back at the interest rate increases that's been over the past sort of 6 months, mid last year, you're seeing the Fed increasing roughly at 75 basis points for virtually all of last year, at back end of last year, up until about December, when it went up to about 50 basis points. And the rate of increase started cooling down. Beginning of March or the end of Jan, at their meeting, they had a 25 basis point. So the rate of increase has certainly been cooling down as inflation has been coming down, both in what CPI is predicting from the BLS, but also obviously what Truflation is predicting as well. So the current inflation rate at the end of Feb is sitting around 4.5 to 4.75, and that last increase was a 25 basis point increase. If you look at some of the other factors, I'll put the financial stability aside for a minute. If you just look at the market environment, the labor market, to dictate where the FOMC would look like with regards to unemployment. The GDP forecast from the Bureau of Economics Analysis would certainly has come down. They've revised their quarter four forecast. So the quarter three forecast was 3.2%. The quarter four GDP forecast came down in the end of February from the first estimate down to the second estimate from 2.9 to 2.7% growth. So a marginal reduction in the GDP growth. If you look at other factors of retail sales, how they're progressing, I think generically month on month, you're seeing a reduction of cooling down retail sales in February over Jan, which is consistent to historical years. I think the rate of decrease that you're seeing this year is certainly higher, predominantly driven by apparel, retailing, electronics, household durables, white goods sales, and of course then also motor parts and repairs. So they've all been dropping off. But the food services, i.e. out of home food eating, food and beverages, they're all still increasing at quite significant rates. So, generally, if you combine that with where we are from an unemployment level, which has been holding around 3.6, gone marginally up from the last update, but still extremely low. And also the wage inflation still increasing. In January, it went up to 7.8 from 5.2. So there's a significant jump in wage inflation increases. The GDP has come down a bit, but retail sales are still strong, and unemployment is still strong, right? So I think from that perspective, from a labor market perspective, it certainly seems to continue to suggest that the labor market is still quite active and has shown no significant signs of changing. There are certain hints and implications of what we're expecting, but certainly no significant ones. The second area then is then, of course, the financial stability. One area around there we look at is household debt. And the household debt has been increasing. It's now sitting at $16.9 trillion for the whole of the US. And that has seen a significant increase, not only in mortgage debt, not only in student loans, in auto loans, and credit card debt, and so forth. It's across the board. So it either suggests one or two things. People are either taking out more debt to put aside the expenditure of other activities, and so they're using that cash to have revenge shopping or revenge behavior, or they're refinancing to keep up with the cost of living increases, and it's most likely around that second one that we're starting to see. Um, so that then suggests that, so that gives you a bit of an indication around the financial stability. I think the other area to think about is also all the banks and the impact that Silvergate has had, Silicon Valley Bank, and what their implications are, and Signature Bank, of course, and what the implications are there for the increased interest rates. So as a result of that, the government there has been rhetoric and there's been talk on the marketplace that the financial stability is going to increase, that the interest rates will probably come down from the 0.5%, even though the inflation number has not cooled down to the 2% target as much as they had hoped. So there was talk that that would result in, then, if you take out the financial stability, I think people were assuming that interest rates were going to go up another 50 basis points. But then, considering the financial stability issues, the questions started coming in at 0% increase. So still staying at the 4.5 to 4.75. But our viewpoint, based on all the information we have at the moment, is that most likely to stick at another 25 basis point increase. So that's all the analysis that we had done at the moment. I'm happy to take any questions, or Stefan or Ivan, if you have any additional comments, please add to that. But that's a bit where we are at the moment.
Yeah, I just add that, I think on the one hand, I think a lot of the rationale behind historically the way inflation was calculated, I think one thing that Powell had set out to do was to find a breaking point. And I think what we've identified is we've hit that breaking point. And how is this breaking point going to impact the FOMC's decision-making process and ultimately the outcome of their meeting, to an extent that, do we want the party to continue, or do we want to really, come to a hard landing? And given the fact that one of the globally important systemic bank has now, had its back broken because of the rising interest rates. The question is, will they recognize Credit Suisse going down as a result of the rising interest rates, or will this be as a result out of their crypto trading? I don't think it's crypto trading, or is it their Archegos investments and continuous chase for profit? Is that what's going to bring down? Is that what brought down Credit Suisse versus just the rise in interest rates? And bear in mind, Credit Suisse is an international bank. It's not only a US bank, so it doesn't only have US treasuries. It has European treasuries. It has British treasuries. It has Swiss treasuries. It has treasuries around the world. And so, what impact does that have? And now that the Swiss government has underwritten all of that liquidity loss on behalf of UBS, who's acquired Credit Suisse, how big is that, right? And what are UBS customers going to be doing as a result of this? Are they going to be pulling out of UBS? I think that's one thing to see. If that happens, given the interest rate decision that's going to come out tomorrow, um, yeah, what will we see a retraction in interest rates? So will we go down? I I highly doubt that. I think we're lucky to stay at zero, um, and I just think it's really hard. Whilst rationale tells us we should be going up another 25 basis points, given the macroeconomic situation, um, the uncertainty, the pressure from Biden to the FOMC as well, right? Bear in mind that it's going to be an election year next year, and you don't want to be have run the economy into a recession when you're up for election. And so there's got to be a lot of political pressure on top of that as well. And just to see how this stabilizes, I would, my gut is telling me that it's going to be a flat outcome. So I don't think you could do a decline. That'd be too much of a face loss and too much of a sign of you know lack of seeing and identifying where the breaking point is by retracting and then going up. You're just going to really break the back, and I think you're really determining that the party is come to a grinding halt, and that's something to balance.
Yeah, I think both of you are on the spot when it comes to what the market actually expects. So up until what happened with the banking sector in US, investors were thinking that there's around 70% chance that we'll see a half point hike. And a week later, after what happened with SVB Signature and Silvergate, uh, there was uh, there was a no investor that basically saw that as a likely outcome. Instead, most of the people saw that the rise of the interest rates will be a quarter of a point, while there was a 35% of them that thought that there that we are close to having a no rate hike in the next announcement. So I think you are in between what market thinks. At this point, I would say that taking into consideration what the government has done on the weekend of the bank failures, where they basically pulled a hard stop on the bank run, at least for now, I would go with 25 um, basis points of going up for this month, and then potentially for next month, because I do believe that the inflation will continue to go down significantly. Then I would go with a 0 basis points interest hike.
So on that note, how do you feel that given the Fed on Monday just announced another $300 billion injection into the financial market, and sort of all of that liquidity coming into the market, is that not going to be inflationary?
Probably it will. We saw what happened the first time they pulled such a move, but I see that more as a long term move. And that money to get into the system, to get spread out across the markets, it takes time. So I don't believe it will be an immediate effect, but definitely it is a inflationary one.
Because a lot of people are saying that in longer term, I agree, it's going to be inflationary. However, in the short term, it's basically like what we have in crypto when you stake your money, right? I mean, it's you're sitting on 10-year treasury bonds. They're trading at a 70% discount. I swap them out, or at because the government's going to pay me back associated with that money 1-to-1 anyway. It's just a question of timing. So today, if I had to sell them into the market, they would be at a significant discount. So at some point, the government's saying, give me those, stake them, I'll hold on to them here, and then I'll cover the loss associated with it, or I'll replace that with a new bond. Is that not the case? And if that's the case, then you're just shifting these losses into and across to the government that says, or the Federal Reserve that will take on that loss and hide it. Whereas all of a sudden, the bank is not reporting a loss anymore because they've swapped out a discounted 10-year bond to a one-to-one price bond.
I see those moves as a taking from one pocket, putting it into another, just shifting the loss from one place to another. So nothing substantially happening. I think we can see that the system is not working as it's supposed to. These kind of moves are definitely in mid to long term destabilizing the whole system, and not sure how, but we'll pay for all of this because it's definitely not. It doesn't look good. So we'll see how it pans out. But all of these things happening with the financial system, with new money being printed, it's showing that we didn't pass through the shocks we had with COVID, with the first money printing. It seems there are a lot more issues that are more fundamental to the whole system.
By the way, if there are any insights that you have in the audience or in the group, in the community here, please raise your hand, and then Aurelian I'd love to get any opinions that you might have as well, and see how what predictions you might have. I see there's some smart individuals in the group here. Anyway, I think my view is still, and I sort of still believe that we're going to, just given the turmoil and given the uncertainty, that it's extremely politically, it's going to be extremely charged to raise interest rates at this point, even though it might come at the cost of this 2% inflation target, which is pretty arbitrary anyway. And if you saw in the hearings when Powell was asked, how did he get to the 2% number? He was actually sidestepping the question quite a bit, where he was just going and saying, oh, it's a general consensus across the other central banks that we believe it's got to be 2%. But why and what the actual justification of this 2% is yeah, it was really nebulous, and I didn't get the feeling that there was a clear answer around that.
So I just had a request for a speaker, but somehow the request went away. So Mike, if you want to ask again, or maybe if that was a mistake, then we can just move on. But don't hesitate to request again. Also, Oliver, did you have any comment on what has just been said?
Yeah, I mean, no, I think the government backing of deposits and of those three banks and all the cash that's sitting in there, and also backing up the debt that's there, I think it's going to have a short-term impact where if it affects consumers, I think the biggest impact it's going to have is it's going to raise the cost of capital, and that increased cost of capital is then going to translate into potentially less entrepreneurial startups because the cost of money is getting getting too expensive, and I think therefore that would have inclined the Fed to look at a 0% increase and maintain it. But given the unemployment, the labor market is so strong, Given household debt is continually going up, it would suggest that people are refinancing to save and to deal with the current inflationary rates. We know that people are looking at getting multiple jobs and keeping the inflation, keeping the unemployment quite low. So, for all those factors alone, I think in the short term, the 0.25 basis points is going to be probably the most likely scenario. I think if the inflation number gets down to around 4%, then I think we might start seeing a more of a longer term view where that number starts to come down again. But I don't think it's going to start coming down. I think at least for the next FOMC meeting, which is in May, potentially even in June, I think the chances of seeing that number come down is quite unlikely.
All right. So,
I mean, the variables, Oliver, to that time point are still so grave, right? We're just early innings, if you will, into what's actually playing out right now with regard to the financial institutions. Um, May is just, I don't know how people can predict all these things into May, other than how the governments are going to react, because I think a large portion of it's also sentimentally driven, right?
No, 100%. But Stefan, if unemployment starts to creep up, and the GDP number in Q1 it comes down, that would likely suggest then that's maybe starting to be a potential turning point in what the FOMC might do with regards to the interest rates. And for me, if you look at the three pillars, is the labor market, it's the inflation and stability of the GDP, and they're trying to avoid a soft landing on on a recession. So if they're trying to avoid the recession, have a soft landing, and if GDP continues, if the third forecast comes out at the end of this month and that 2.7 goes down even further, and the January number comes out lower, then I honestly think you're getting to a level where the ceiling that people estimated before the recent financial instabilities that are in the marketplace with the three S banks was 5.25. I think that ceiling is probably quite realistic still today.
Yeah, and then but then you take into account around unemployment, right? I mean, the only industry that's really cut back is the technology industry. I look at since 2020, once COVID hit, 80% of all new hires were employed by government or government, offices, um, and you then take that into account. So the government isn't going to retract or cut its teams or staff or offices, and at the same time, the deglobalization is bringing manufacturing back into the US. And so as we bring back manufacturing and put that onshore, we are going to need to hire more construction workers. We're going to need to hire more, relevant skill sets to support the manufacturing, the development, and the assembly of all these different types of new products that we're bringing onshore. And so the foreseeable future, maybe because interest rates are higher, I can't invest in these factories anymore, and I can't build out the onshoring. And so, actually, we shift back away from deglobalization back to a globalization strategy, which would be a flip turn as well, right?
Well, take it one step at a time. I think you're saying that the increase in the labor market, the salary increases is causing one issue, right? And it's not only the tech sector who's hiring; quite a lot of sectors that are hiring, but it's about the the food industry, the services industry, hotels. They're all back. Airlines, they are recruiting gangs. They laid off quite a lot during the pandemic. And they're coming back, right? And to a certain degree, where people like Walmart had to increase salaries above market rates just to retain their employees. So I think there is quite a strong labor market there currently in the US. Are people taking two jobs? Quite likely. Are they all full time? No, they're not. There are a lot of part time jobs. Um, so that's one area. So I think the labor market will continue to be strong, and it'll be interesting to see what happens in the next couple of months, especially if GDP comes down, and then we'll see how that progresses. So yeah, and if you pile on top of that your comments about manufacturing in the US and so forth, and bringing back manufacturing to the US, then yeah, that's going to add increase more labor charges. So which is going to be longer term outlook would suggest that labor market remains strong. So yeah, there are a lot of variables between now and June. Next two FMOC meetings after this to see what happens. But yeah, there's a lot of variability in the marketplace at the moment.
And just to add upon that, as I see it, it's looking at what has been happening and what's happening now. To me, only it seems that government is just reacting what's happening, and instead of being proactive. And in the latest event with the banks, they just basically completely lost another tool that they could use to fight the inflation problem. And if you look at it from a perspective what you Oliver mentioned, you have three pillars: you have wages, you have prices, and then you have the financial stability. Two out of those three are, let's say, it's on fire. So, and they are interconnected, and fighting one, you can set off the other one on fire. So by financially having the banking system that is not looking stable, you're basically losing the interest rates as a strong tool to fight the inflation, which was the case until now. And that being the case, as you guys predicted, and as probably the whole market predicts, there are two options: either no increase or 0.25. And in case of a no increase, short term that is a good thing. So it's basically not increasing rates, and it's trying to stop the spread of the bank contagion. But what it implicitly says is that the Fed is afraid that by raising interest rates, they could further destabilize the banking system. And if they are afraid, that means that something else might be coming on in the banking system and in regards to the financial stability. So it's becoming more and more interesting, and I think the government is doing similar mistakes that they did in 2008, just being reactive instead of proactive to the current situation.
So I'm just gonna give a few seconds for anyone who wants to be a speaker, because I've been having a few requests, but for some reason, as soon as the request is granted, the the speaking spot is removed right away. So if you've made a request and wanna jump in now, uh, just let me know right away.
Or if this doesn't work, you can write it in comments, and then we can take it from there.
That works too. While while we wait for that, Stefan earlier on mentioned the upcoming election, and I was wondering if any of you wanted to comment what may be, and I'll accept the request right away, and I'll get back to my question later. So you're on if you want. Not it jumped again. I'm not sure why it doesn't work. Right. So feel free to leave it in the comments so that
We have a comment here. There's somebody that has put in, the Fed. The next call is easy, right? The meeting is an easy call. If they hike with the threatened 25 basis points, 5 more holes in the dike will crop up in the next few weeks. So we'd see another couple of Credit Suisses and SVBs. So more banks, 5 more banks would go down. Is the comment there? Interesting. I mean, I think Yeah, I mean, I tend to agree. I think that if we do raise the rates, a couple of banks are going to go down. But is this not a strategy, maybe? Playing devil's advocate here, the strategy might be to have more regional banks go down. If the regional banks go down, then we, Fed now and CBDCs come to the savior, and all of a sudden you don't need all these different regional banks anymore. You've got a Fed now solution that can step in and help resolve some of the issues going forward. And then your lender of last resort, which it is today anyway, is the Fed. All of a sudden now, the Fed is really the lender of last resort, and there's no more middlemen in the way.
Okay. So coming back to the question I was asking earlier, so you mentioned, Stefan, that there is an upcoming election. What kind of moves could the government make to either help bringing the economy in the right direction for the elections, or at the very least, put it in a place that provides the illusion that everything is fine, so that the elections can be favorable to the current government?
I mean, my view is they don't want a recession, right? So I think if you're in a recession, that means that the regulation and the economic decisions that you made for the country did not work in the favor of the country and created a large um, constituent of unsatisfied voters. Um, and so what have I got to do as a government? Number one is I put a lot of pressure on the Fed to reduce interest rates. That's one option. To incentivize the economy and make money flow cheaper again, and push the can down the road. Number two is I run Fed now. I accelerate the launch and deployment of my CBDC Lite, and provide direct lending facilities to infrastructure projects and other projects that are out in the market, um, and try to stimulate the growth and economy that way. Um, because in the end, if interest rates do go up, if savings cannot be accessed, there will be, and businesses can no longer bank with the existing banks that they've been working with, there will be layoffs. There will be there will be a significant impact on the economy. So much so that people can no longer pay their rent. They can no longer buy the food at the grocery store. All of these things will start to kick in, which will create, the potential of, yeah, unsatisfied and, dissatisfaction, and unhappiness, and less likely to vote. So those would be, if I were in the government, I would definitely be trying to push for my Fed now. I would be looking and working with the local governors and the local senators and the local, House committee members to then, what projects do you need in your state or your district, and let's allocate a budget for that. And here you go. I will fund this out of the Fed now, directly from the Fed. I will feed these projects into your economies because these five banks are going to go bankrupt, which has an impact of 500,000 employees. The population of 500,000 people in your, state, and we will hire them with these kind of elements, and we'll help build a new factory for semiconductors. We'll get work with Intel to do that. We'll work with GM to build a new car manufacturing in that state, et cetera, et cetera.
All right. Did Ivan or Oliver want to add anything to this?
No, not from my side.
Yeah, I think we just have to wait and see what will happen.
Okay, cool. So I have one comment that came through from one of the listeners who tried to be a speaker, but unfortunately it didn't work out. So the comment is that the supposed 2% inflation target is called PCE, which was engineered to underreport inflation. It's important not to conflate that target with headline CPI, let alone Truflation.
Interesting. So yeah, and so yeah, I mean that definitely okay. That's interesting. Is that something when Powell was at the Senate hearing? Did you see what he was trying to say when he was asked where this 2% magical 2% number came from? He didn't bring that up, and so this is new news to me, and this is interesting. And definitely thanks for that insight.
So we have a new speaker, Jimmy. So if you have any question, go ahead, or any comments, please do go ahead. And you're on mute right now.
Just wanted to say I'm a chicken nugget.
That's great. That's great news.
And how much is a chicken nugget these days?
Oh, price went up.
Is it gone up in price? Price went up. We track McDonald's, don't we, at Truflation.com? We can check it out.
All right. So following, there's a follow-up comment in the comment section from Silver Burner. So regarding Fed now and CBDC sweeping in as the savior for a failing regional banking system makes total sense.
Yeah.
I also agree that they need an emergency to force adoption. It's an extremely scary prospect.
Yeah, so I mean, the emergency scheme is super easy. You want free money? Adopt. Download this wallet. Look what they did in what was the country? I think it was El Salvador, where they said download this wallet and you get $1,000 included in that. And if you need to pay your rent, if you need to pay food at the grocery store, you need to pay tax. All of a sudden you can use that $1,000 in CBDC or Fed Now Lite, and then you'll be able to access the money or go to this department or this tax office or IRS department and use this to claim real US dollar or I don't know, fresh printed money.
Fresh minted.
Fresh minted, thank you.
All right. So following having a chicken nugget, we have another request from a listener called Dog Meat. Do I roll the dice? No, it's gone. So no problem on that. Perfect. All right. Does anybody else have any question?
One thing is, do the rise in interest rates and this, impact any of us directly, right? Directly, it's not going to impact any of us. Indirectly, unless we have, even if you have mortgages or something, it won't impact you because you've got most probably a fixed term and fixed interest rate on your mortgage. It only impacts you if you have plans in the near term to then go get a new mortgage to buy a new house or get a loan to buy a new car or etc. So I think that's one thing to bear in mind, but indirectly it will impact a lot of us going forward. And
So Stefan, I would caution that. I think there will be a lot of direct impact, right? So inflation rates going up across the board. So we just be. I think you're right. The mortgage rates are generally 15 or 30-year mortgage rates, but it does have a short-term effect on other ones. So whether it's short-term unsecured loans, whether it's car auto loans you mentioned, or anything else, and all the household debt is all increasing, right? So we've got to bear that in mind as well.
And the household debt is that credit card debt? Is that short term debt? Is that what's the form of the debt?
Well, credit card debt. Credit card debt is all unsecured loans. It's all short term, right? Whatever you take out in credit cards, and that's increasing month on month. So people are maxing out their credit cards, or just spending more, and or repaying it on another card, using multiple cards to repay it.
So I see Michael Green's here. Michael, do you have an opinion on what the Fed has in terms of plans for the interest rates coming up tomorrow? What are your thoughts? Love to hear your thoughts. Can you make Michael Green, give him speaking capability? Are you up for that, Michael?
I sent the request. Let's see. Yeah.
Okay. Chicken nugget troll. There you go.
Is that a thing?
Yeah. I don't know. I think we should have a Big Mac index come up on our dashboard pretty soon. And then I'd like to see the Red Bull in contrast.
All right. So no pickup on the request for Michael.
Okay.
We're coming up to the 45 minutes mark. So any other comments?
I will leave it there.
Yeah, I think Yeah, I think so. I think I think our official comment is a 25 basis point rise. The sort of sentiment data, given the latest macro impact and situation with all the financial institutions, is that it's going to be a flat outcome. And I think those are really the debate, really on where it can go. A reduction in interest, a decline in interest rates is very unlikely. And I think that's sort of a quick summary of where we're at, given the last 45 minutes.
All right. Then there is one more request for speaking that is trying to connect, but it's jumpy again. So I sent a request for speaking once more. So we'll give that a chance. And if not, if it doesn't work again, then we'll unfortunately have to bring this to a close.
Is that the spaces that's being so difficult? Is that challenging?
There's no reason why it shouldn't work. I'm pressing all the right buttons, so I imagine there may be a problem with the software itself. It's possible. Hopefully, it will be resolved by the time we get our next Twitter space.
Yeah, because that's a lot of potential speaking requests that have been working. Anyway.
Right. Yeah. All right. So it doesn't seem that it's going to connect this time around. Never hesitate to tweet at us anyway. While it's not as direct as the Twitter space, it's still quite quickly responded usually. So don't hesitate to tweet at us. So while this connection is trying to happen, I'm trying again. Let me remind you that our next Twitter space will be on April the 11th for the next BLS update. And also, if you want to go back to those conversations for your own reference or for anything that you might need, this will go up. The recording for this Twitter space will go up on YouTube, on a Truflation YouTube channel within the next hour or so. and it will also be available on most podcast listening platforms. So it's there if you need it, if you want to go back to it, or if you arrived later on and want to go back to it from the beginning again. Right. So the speaking reconnaissance that it's going to go through this time around, I'll try to figure out what happened, do a bit of research, and hopefully next time everything will work much better. Thank you everyone for being here. Thank you to the speakers, and bye for now.
Thank you.
But